Hi, and welcome to the Food Fund, where we explore all things related to investing in food and beverage stocks. My goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will love this channel. In this video we will be exploring Coca-Cola and seeing if it would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, cue the logo. Starting with the 1-year chart, we see that Coca-Cola had a CAGR of about -0.7%. Zooming out to the 5-year chart, we see that Coke had a CAGR of 8.2%. This is a really good return that has been pretty consistent excluding the 2020 incident. Now, let's take a look at the fundamentals. Gross margin is a very healthy 58%. Revenue has compounded at 8% over the past 5 years, most recently hitting $43 billion on a trailing 12-month basis. With this gross margin, that means that $25 billion is going on to pay for operating expenses, taxes, and interest payments. Seems like Coca-Cola can manage running a business on $25 billion per year. Looking at free cash flow, we see a 9% CAGR over the last 5 years. However, CapEx has increased at a CAGR of 3%, while stock-based compensation increased even more rapidly at 9% CAGR. Luckily, stock-based compensation is very small compared to free cash flow, accounting for only 4% of free cash flow. Next, weighted average shares outstanding is essentially unchanged. Ideally, I would like to see the share count decrease, but no increase also works. Now let's view my favorite metric. Return on invested capital. Return on invested capital is nearly unchanged after 5 years at 16%. While I would prefer to see return on invested capital increasing over time, 16% is very respectable. Another favorite metric is cash conversion cycle, a measure of operational efficiency at the company. Going from a peak of 47 days in 2018 to -250 days most recently, Coca-Cola is demonstrating strong leverage with their suppliers. A negative cash conversion cycle means that a company's inventory is sold before they have to pay for it. In Coca-Cola's case, it means that they can reinvest the proceeds from sales back into the company for nearly 8 months before they have to pay suppliers for the costs to make the goods they already sold. Got to love when great companies work magic like that. Last, let's explore Coca-Cola's debt metrics as defined by Investopedia. The current ratio measures a company's ability to pay short-term debt and obligations due within 1 year. The debt-to-equity ratio is used to evaluate a company's financial leverage and is calculated by dividing the total liabilities by the shareholder equity. The net debt-to-EBITDA ratio shows how many years it would take for a company to pay back its debt if net debt and EBITDA are held constant. Glad to see that we are not the only ones that find EBITDA delightful. For Coca-Cola, the current ratio is 1.2. The debt-to-equity ratio is 0.7, and the net debt-to-EBITDA ratio is 2.1. So now that we know all about the fundamentals of Coca-Cola, should it be added to the portfolio? Before sharing my final thoughts on that, please subscribe, like, and share this video. Your support means a lot to the Food Fund, and your continued viewership is a huge help to grow the channel. Now, let's get into my final thoughts. Okay, let's write out some key values for Coca-Cola. It is a beverage company with a gross margin of 58%. I like to start with gross margin because if this sucks, then no matter how great the other metrics, the company will be terrible. 58%, especially for a product company, is an excellent gross margin. The 5-year revenue per share CAGR is 3.9% and the 5-year free cash flow per share CAGR is 10.6%. This shows that the company is growing healthily. The fact that free cash flow is growing faster than revenue means that the company has good operational efficiency, which we see demonstrated here in the next metric. A return on invested capital of 16% again highlights that for every dollar invested at Coca-Cola, the company is able to turn that investment into 16 cents per year. This also means that it takes Coca-Cola less than 5 years to break even on their investments. Next, a low cash conversion cycle is desirable. A negative cash conversion cycle is even more awesome. Again, we see the strong operational efficiency of this company. Concerning debt, a net debt to EBITDA of 2.2 means the company can pay off its debts with a little over 2 years of EBITDA. Very nice. So from a fundamental standpoint, Coca-Cola is an amazing company. Now let's switch our attention over to valuation. Coca-Cola is mildly overvalued relative to the S&P 500 with a ratio of 1.3. It would be nice to get a company when the price to earnings ratio is lower, but good companies often trade at a premium to the market. The price to earnings growth, or PEG ratio, of 4.1 tells me that Coca-Cola may be a bit expensive relative to its projected earnings growth. In summary, Coca-Cola is an amazing company that I am definitely considering. Let's set it here on the watch list and see what other companies are out there. Many thanks for watching. What do you think about Coca-Cola in this analysis? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.